Have you just started crypto trading? Does it feel a little bit complex with all the charts, candles, and strange words being thrown around? Don't worry. I know exactly how that feels. Every trader begins at zero, and today I want to simplify it all for you. By the end of this video, you'll understand the building blocks of crypto trading, from the basics of reading candlesticks to the mindset that separates winners from losers. If you're new here, we release a video about crypto in a way that's easy to understand. Before I continue, remember, this is not financial advice. I'm just sharing educational content, so always do your own research before making trades. The first thing we need to talk about is why crypto trading is unique. Unlike stocks or forex, crypto trades 24 hours a day, 7 days a week. There's no closing bell, no weekend breaks. That means the market never sleeps. Prices can move 10, 20, even 30% in a single day. Compare that with traditional stocks, where a 5% move is already considered massive. And there's the psychology. Crypto is still dominated by retail traders and big whales. Emotions like fear and greed drive price action far more than in mature markets. A single tweet from a celebrity or a billionaire can send coins flying up or crashing down in minutes. Think back to when Elon Musk tweeted about Bitcoin and Dogecoin. Prices jumped almost instantly. That kind of emotional reaction is unique to crypto. Because of this, manipulation is also stronger. Whales can move small coins around like toys, creating fake breakouts and trapping inexperienced traders. This is why learning the basics is so important, so you don't fall for these traps. Now let's move to the foundation of all technical analysis. Candlestick charts. Candlesticks were invented hundreds of years ago in Japan, and they're still the best way to visualize price movements. Each candle shows the open, high, low, and close for a specific time period. A green body means the price closed higher than it opened, bullish. A red body means it closed lower, bearish. The wicks tell you the extremes. The top wick is the highest price, the bottom wick is the lowest. A big candle body shows strong momentum. A tiny candle with almost no wicks often signals indecision, and sometimes the start of a reversal. For example, imagine Bitcoin trading at $112,000. If we see a candle with a long lower wick, meaning sellers push the price down to maybe 110K, but buyers step in and brought it back up near 112K, that's a bullish sign. It shows demand is there. On the other hand, if we see a candle with a long upper wick, price shoots up to 115K, but closes back down at 112K. That shows sellers are stronger at the level. Patterns like hammers, dojis, and engulfing candles give us clue about who's winning the battle, buyers or sellers. Learning to read candles is like learning to read market psychology in real time. Now that you understand candles, let's talk about support and resistance. These are price levels where markets tend to react. Support is like a floor, where buyers step in. Resistance is like a ceiling, where sellers take profit or short. These levels are often round numbers. For Bitcoin, 100K is a psychological level. Right now, Bitcoin is near 112K, and the all-time high of 124K is strong resistance. If Bitcoin pushes through that resistance with strong volume, traders often set a target equal to the size of the prior range. In this case, the range is 112K to 124K. That's a 12K gap. Add that on top of 124K and the next target could be around 136K. But remember, markets love to test these levels. If Bitcoin breaks above 124K, don't be surprised if it comes back down to retest that level before moving higher. The same goes for support. If Bitcoin drops under 110K, the next strong support could be 105K. Traders often place their buy and sell orders around these zones. Now let's move on to technical indicators, the tool traders use to confirm what they see on the charts. The most basic one is volume. If the price moves up with rising volume, that's a strong trend. If price moves up on weak volume, it might be a fake out. Always check volume. Next is RSI, or Relative Strength Index. It ranges from 0 to 100. When RSI is above 70, the market is considered overbought, meaning it might be due for a correction. When RSI is below 30, it's oversold, a potential bounce zone. For example, if Bitcoin rockets from 112K to 120K in a few days and the RSI hits 80, many traders expect at least a short-term pullback. Then we have the MACD, the Moving Average Convergence Divergence. It's a momentum indicator made of two lines. When the MACD line crosses above the signal line, it suggests bullish momentum. When it crosses below, bearish momentum. Traders also watch divergences. If Bitcoin makes a higher high but the MACD makes a lower high, it's a warning sign of weakening strength. Moving averages are another classic tool. The 50-day and 200-day moving averages are especially important. If the 50 crosses above the 200, that's a golden cross, often a signal for a long-term bull trend. If it crosses below, it's a dead cross. Right now, if Bitcoin's 50 days trending above the 200 a day while price is around 112K, many traders see that as a confirmation that uptrend is intact. Finally, Bollinger Bands measure volatility. When the bands tighten, called a squeeze, it often means a big move is coming. If Bitcoin is trading sideways around 112K and the bands are getting narrow, expect volatility soon. Now, here's the golden rule of crypto. Bitcoin moves first, altcoins later. Bitcoin is the king of the market. Almost every altcoin follows its lead. When Bitcoin is strong, altcoins can fly. But when Bitcoin crashes, altcoins usually collapse even harder. Traders also watch something called Bitcoin dominance, the percentage of the total crypto market cap held by Bitcoin. If Bitcoin is rising but dominance is falling, that means altcoins are rallying even faster. This is what people call altcoin season. On the other hand, if dominance rises during a crash, altcoins are often the ones bleeding the most. So, before you trade any altcoin, always check what Bitcoin is doing first. Next, let's talk about the risks in crypto trading. The market is full of traps. Small altcoins can be manipulated by whales who pump the price, lure in new traders, and dump everything, leaving retail holding the bag. Leverage is another huge risk. When you borrow money to increase your position, even a tiny move against you can wipe you out. A 5% dip in Bitcoin might not sound like much, but if you're on 20 times leverage, that's complete liquidation. And then there are short squeezes. Imagine a bunch of traders betting that Bitcoin will drop from 112K. If instead it shoots up to 115K, all those short sellers are forced to buy back their positions, pushing the price even higher. That feedback loop can create violent spikes. That's why my advice is simple. If you're a beginner, stay away from leverage. Focus on learning the basics and protecting your capital. So, we've covered the tools, the risks, and the unique nature of crypto. But the final piece of the puzzle is the most important: strategy and mindset. The biggest mistake beginners make is overtrading. They feel like they need to be in the market all the time. But good trading is not about constant action. It's about waiting for the best setups and acting with discipline. One way to build a discipline is by keeping a trading journal. Write down every trade you take, why you took it, where you entered, where you exited, and how it turned out. Over time, you'll see patterns in your own behavior. Maybe you cut winners too early. Maybe you hold losers too long. Reviewing your journal will help you improve much faster instead of winging it. Patience is also key. Trades don't always play out in hours or even days. Sometimes you need to wait weeks for your target. If Bitcoin breaks 124K, for example, it might take a while before it reaches the projected 136K. Don't let impatience ruin your plan. And above all, control your emotions. Fear and greed will tempt you to break your rules. Fear makes you exit too early. Greed makes you chase pumps or over leverage. The best traders are calm, disciplined, and consistent. So, to wrap it up, crypto trading is unique because of its volatility, manipulation, and emotional swings. Learning candlestick charts, support and resistance, and technical indicators give you the tools to read the market. Watching Bitcoin first helps you understand altcoin moves. Avoiding leverage and staying aware of risks keep you safe. And building patience, discipline, and a strong mindset turns you from a beginner into a real trader. That's it for today's video. I hope you found this helpful, and if you did, make sure to subscribe to Captain Altcoin. Hit the like button and share it with everyone who's just starting their trading journey. And let me know in the comments what's the hardest part of trading for you right now. Thanks for watching and see you soon.